Good morning. Yes, you're absolutely right. I think this has been an incredibly hectic quarter for investors. Now, for me, a global recession is still not the base case for 2022. I acknowledge that recessionary risks have risen so far this year, given the risk of a shock to commodity prices that really does feed through into squeezing consumer incomes. But when you look at the strength of consumer balance sheets coming into this shock, we had strong tailwinds. Consumers were still sat on large amounts of pent-up savings that have been created over the course of the past 2 years. Labour markets also running very strongly. So the squeeze on real wages has not been as big, given that actually, nominal wage growth is going okay. So yes, we know that inflation is now going to be higher, and it's going to be higher for longer. And we know that growth is going to be more moderate than I would have expected at the start of this year. But I still think that there are enough tailwinds, particularly for the US consumer, that should keep the global economy on track this year, albeit at a slower pace.
There are a lot of moving pieces here. I take your point around the savings rate and how much extra consumers have built up in the bank. But we know there have been outsized increases to an inflation. Every time someone wants to take a holiday, it's much more expensive than what it was before. Now on a day-to-day basis, going to the pump or just going to buy average goods, that's increased. So there's this a filter-through effect on a daily, weekly basis. At what point do those savings dwindle? And we're looking at a consumer that's facing a much more expensive environment, potentially without the pay rise that they may have been hoping to achieve because growth is now looking uncertain.
So the answer to that really all depends on where you look, because obviously when you take the US, their energy independency is that much greater that I would not expect to see the same squeeze on US consumers as we'll be facing in the UK or European consumers. I think another important factor to consider here is the policy response, because we know that energy prices are rising, and I think it's fair to say that risks to energy prices still point to the upside more than they point to the downside. But what we're also hearing is that governments are willing to step in. In very simple terms, governments have lost their fear of debt. And this is another crisis that in the mind of European governments is not the consumer's fault. In the same way that in 2020, COVID-19 was not the consumer's fault, governments were willing to step in to shelter corporate and consumer balance sheets. I think we're going to hear more and more over the coming months about government measures to try and protect particularly lower income parts of the population from the full effect of these higher energy prices. So you're absolutely right. The consumer outlook has deteriorated. And I think the risks to growth, particularly in the Eurozone, now are elevated. But I'll be watching for that policy response, because if it's governments that decide to step in, then you shouldn't see as big an impact on measures as retail sales as you would expect normally, just given the jump in prices that we've seen.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.